If you don't have enough money to trade the big names that you want, like the Mag 7 names, I'll show you how you can do it with just a little bit of money by using the ETF alternatives. Watch this video, stay until the end because I'm gonna show you my personal favorite at the end of the video. Let's jump right in. Okay, so we're gonna walk through the Mag 7 and I'm gonna show you an alternative for each and every single one. I'm gonna use Direxion, which is an ETF company that basically mimics the individual Mag 7 stocks, but on a 2x basis. Now, you probably don't want to buy and hold these for a long time because they have daily resets, but they're pretty good at trading options on. And just like regular stock options, you don't want to pay regular sticker price. You want to start by selling a put that's lower than where it's trading, collect cash, and only buy it if it goes on sale. And then, if you do have to buy the shares, you sell a covered call against it right afterward. So let's start at the top with Apple. Now, this is my trading platform on Thinkorswim, and I want to show you side by side Apple versus AAPU, which is the 2x Direxion ETF for Apple. And you'll see they look kind of similar. And that's expected because AAPU is intended to mimic Apple on a 2x basis. Now, the 2x part of it indicates that it does have a lot more risk. So in other words, if Apple goes down significantly, AAPU will go down probably twice as much. So you want to keep that in mind. So the purpose of using these ETFs is because, for example, Apple right now is trading at $278 per share, as we can see here, and its corresponding ETF, the 2x Direxion AAPU ticker, is only trading at $38 per share. So it takes a lot less capital to be able to trade it. Now, when we look at the options chain, not all of them have weekly options. So some only have monthly options, like this one, for example. So we're going to look at a December 19th contract. And because this is trading at $38 per share right now, we want to start by looking at, let's say, a $35 put. So we only want to buy it if it goes down pretty significantly. So one thing you'll notice when we look at the options chain, it does have quite wide bid and ask spreads because these aren't traded as much as the regular underlying ticker. So you are a little bit limited. In fact, I'm showing the open interest as well. So we'll see the open interest is not that big. If we compare it to Apple as an example, the open interest on Apple is in the thousands, whereas AAPU is in the double digits. But I want to walk through all these 7 tickers with you to give you an idea, and one of them might resonate with you. So for example, if we start with a $35 AAPU put, it last traded at $60. And this has a delta of 21. So I always look at the delta when I'm choosing a strike price for a put because I want to choose something typically pretty far away from where it's trading. I don't really want to buy the stock because I prefer to keep my money in cash and drive income off my cash rather than having shares, because then it gives the added fluctuation of paper gain, paper loss. Now, we're always going to calculate our rate of return before we make a trade because we want to make sure if the trade is good relative to the risk that we're taking. And that's very easy to do. So I'm just going to divide the premium that I'd be making, so in this case $60, divided by the capital that I have to put up, in this case $3,500, because it's a $35 strike price times 100 shares. So I would be making about 1.7%. And this particular trade is about 3 weeks' time because today is November 29th. Of course, today the market's closed, but this is a December 19th contract. So if I was to annualize my premium out, I'm just going to divide by 3 and I'm going to multiply by 52 to get an annualized rate of return. So we're making about 29.7% on our money. Next, let's go to Amazon. So Amazon right now is $232 per share, but the corresponding Direxion 2X ETF is AMZU as the ticker, and it's only $37.62. So we're going to do the same thing, and we're going to look at AMZN here, and we're going to look at AMZU here. Again, we're just going to look visually at one against the other. Now let's take a look at the options chain. So AMZU also only has monthly options. So we're going to look at the December 19th contract, and we're going to look at a $34 put, because that gives us a delta of about 22. So there's a 22% likelihood that the stock is going to go from where it is now, $37.62, all the way underneath $34 before the expiration date on December 19th. Now remember, we keep the premium regardless. This last traded at $80. So again, we're going to calculate our rate of return, $80 into 3,400, because that's the amount of money that we're putting up using all of our own money and not using any margin. So we're making about 2.3% on our money. And again, this is about 3 weeks' time. So we're going to divide by 3 and then multiply by 52. So we're getting an annualized rate of return a bit better than Amazon of 40%. Next, let's look at Google. So Google is $320 per share, whereas the corresponding ETF, GGLL, is only $105 per share. So let's just take a look at the chart and make sure that they look similar. which they do. So let's next look at the options chain. And GGLL also only has monthly options, no weekly options. So we're going to look at December 19th, and we're going to look at about a 23 delta, and that's a strike price of $95. So we're committing to buy 100 shares if the price drops below 95 before the expiration date on December 19th. So this last traded at $257. So we're going to divide 257 divided by 9,500, and that gives us a rate of return of about 2.7%. So we're going to divide that by 3 times 52 to give us our annualized rate of return, and we're making about 46, almost 47% on our money. Next, we're going to look at Meta. So Meta is a super expensive stock. So right now Meta is trading at $647 per share, but you can trade the corresponding ETF, METU, and let's take a look at the chart and just make sure that they look pretty similar. So we're going to put Meta on the left, and we're going to put METU on the right, and they do. Now we're going to look at the options chain for METU, and again, a similar scenario where there's only monthly options available. So we're going to look at December 19th, and I'm going to look at a 25 delta, and that's a $29 strike price, and it last traded at $77. So we're going to divide $77 into 2,900, which is the capital that we need to make the trade, divided by 3 weeks, times 52 to annualize our rate of return out, and we're making about 46% on our money. Next, we're going to look at Microsoft. So Microsoft is $492, but you can trade the corresponding ETF, which is MSFU, and that's only trading at $46.15. So let's take a look at the chart and make sure that they look similar, which they do. Now let's take a look at the options chain, and it's the same scenario, only monthly options. So we're going to look at the December 19th contract, and we're going to look at a 24 delta, which is a $43 strike price, and that last traded at $75. So we're going to divide $75 into 4,300, which is the capital that we need to make this trade, divided by 3 times 52 to annualize our rate of return out, and we're making about 30% on our money. Next, we're going to look at Nvidia. Nvidia is $177 per share, whereas the corresponding ETF, NVDU, and remember, these are 2X ETFs, so they do have more volatility than the underlying, is $112 per share. So we're just going to make sure they look similar, which they do. Now let's take a look at the options chain, and this is similar where there's only monthly options. So we're going to look at the December 19th contract, and we're going to look at a 24 delta. That would be a $100 strike price. So it would have to drop from $112 where it's trading now under $100 before December 19th in order to have to buy those shares. And that last traded at $400. So we're going to divide $400 into 10,000 because that's the amount of capital we need to make this trade if we're putting up all the money. And that gives us a rate of return of about 4%. So I'm going to divide by 3 to get my weekly rate of return and then multiply by 52 just like we've been doing previously. And that gives us an annualized rate of return of a little bit more than 69%. Next, we're going to move on to my personal favorite, Tesla. So Tesla right now is $430 per share, but you can trade TSLL, which is the corresponding ETF, and that's only $18 per share. So let's just take a look at them on the chart and make sure that they look pretty similar visually, which they do. Now let's take a look at the options chain. Now TSLL has weekly options. So we're still going to look at December 19th because I want to compare apples to apples for you with all of these magnificent 7 companies. But if you wanted to, you can trade it by the week. And I typically prefer weekly trading for a couple reasons. Number one, I don't know where the stock is going to go, where the market is going to go. And also I want to make income for myself each and every week. But let's take a look at the December 19th contract to keep everything similar to how we've been doing it. And let's look at, for example, a 22 delta. Also, by the way, you'll notice the open interest is significantly higher on TSLL versus the other ETFs we were looking at. So that would be a $16 strike price, and this last traded at $59. So we're going to divide $59 into 1,600. So you only need 1,600 to make this trade, not even using margin. And that gives us a rate of return of about 3.6%. Divide by 3 times 52. That gives us an annualized rate of return of almost 64%. Now that's my personal favorite. Now I wanted to also show you guys a bonus. QQQ is a technology ETF. So it has a lot of these Mag 7 companies in it, but it's trading at $619 per share. You can trade the corresponding ETF, TQQQ, which is the leveraged ETF of that ticker, and it's only trading at $54 per share. So let's take a look at the chart just to make sure that they're similar. So we're going to look at QQQ on the left, and then we're going to look at TQQQ on the right. And we just want to make sure visually that they're similar, which they are. Now let's take a look at TQQQ at the options chain. So this is similar to TSLL in the sense that it has weekly options, which is very advantageous when you're selling options. So let's just stick with the same format, and we're going to look at the December 19th contract. Now this ticker as well is more heavily traded than some of the other Mag 7 stocks, because we can see the open interest is much higher. So let's take a look at, let's say, a 21 delta, because that's kind of similar to what we were looking at previously. That's a $48.50 strike price, and it last traded at 112. So we're going to divide $112 into $48.50, because that's how much money we'd need to make the trade if we're not using any margin. And we're making about 2.3% on our money, again, for 3 weeks. So we're going to divide by 3, and then we're going to multiply by 52 to get our annualized rate of return. And that gives us about a 40% annualized rate of return. So you see, you can trade big names like Meta, Microsoft, Nvidia, Tesla, etc. in a creative way, especially when you don't have as much capital to put up, and that can be very advantageous. Now remember a couple of things. Number one, we talked about most of these ETFs don't offer weekly options. They only have monthly options, so that's one of your considerations. The second consideration would be that they're not traded as frequently. So when you have tickers that aren't traded as heavily as other tickers, you typically will have kind of a wide bid and ask spread, which ultimately means it's harder to get out of a position if you wanted to liquidate a position. And also your fill is typically not as favorable as if you're trading something that is very, very liquid. And then also, as I mentioned previously, these are leveraged ETFs and they reset daily. So they're not really meant to be a buy and hold position, but typically we're not trading options as a buy and hold strategy anyway. What we're doing is selling puts out of the money pretty significantly below where the stock is trading. We're collecting premium for committing to buy those shares if the stock drops below that price before the contract expires. And if the stock price doesn't drop below that price, we don't buy the shares, but either way, we keep the premium. So the whole purpose of selling puts is to create income for ourselves on a regular basis and only buy the stock on sale if it goes down. Much, much better than going to the marketplace and buying a stock that we like and paying sticker price for it. Don't you think? So what'd you guys think? Pretty cool, huh? Super, super easy. Listen, once you learn how to trade, learn 2 strategies, selling a put, selling a covered call, literally spend 15 minutes per day and just put cash in your pocket every single week. Happy trading. If you like this video, smash the like button. Subscribe to my channel. I'm putting up a video every single day for 1,000 days. Today is day number 145. Comment your favorite ticker here and I'll do a video on that next. Thanks again.